In this video, we're going to talk about Progenity, trading under the ticker symbol PROG. We're going to cover the price action over the past few trading sessions, the company itself, and my recommendations regarding buying, holding, or selling the shares. If you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. But before the video begins, I'd like to clarify a few things about the timing when they're uploaded and their timeliness regarding the latest market developments. So most of my videos are recorded and scheduled for the next day. And if there are significant volatile movements during the trading day, obviously they won't appear in the video of that day. With that being said, to the extent possible, my analysis will be based on the medium term and the intraday movements. The reason why it shouldn't matter that much though is because most people investing in stocks, generally speaking, keep their positions open for at least a couple weeks. With that being said, if there are significant movements that happen after my videos are posted, either they will not affect the overall picture, or if they're significant enough, it'll be mentioned in the next video about the stock, with reevaluations of the circumstances as needed. Progenity is a company operating in the medical services industry and is specialized in diagnostic tests for clinics. It was founded back in 2010 and headquartered in San Diego. The company is valued at $392 million according to the market, and it's valued at $321 million based on the enterprise value. In other words, the market is currently trading Progenity at a premium, which is both due to the company's fundamentals and the ongoing short squeeze efforts. Over the past 10 days, the average trade volume has been 183 million shares per day, and the recent trading sessions saw historically high trade volume, going between 190 million shares to more than 350 million shares a day. What all that means is that Progenity is one of the hottest stocks to trade in the stock market right now, and that there are reasons to believe that most of this trading volume is bullish. Now, keep in mind that even if the company also has a promising business, the main appeal of Progenity is the short squeeze play. There are huge amounts of short positions in the stock, and if they are forced to recover these positions because of the squeeze, they would provide an even higher boost to the company's share price. Compared to many other short squeeze stocks, Progenity is showing a lot more promises than many of them because the stock price has been going up in phases ever since the end of September. The price would first surge, pull back, stabilize for a few days, and go higher once again. Keep in mind that there is no scientific backing behind the short squeeze theory other than the momentum in the market and the basic supply and demand. In that case, it is completely possible for a stock to go back to where it was simply because retail traders would give up the efforts or cash out prematurely. Right now, that momentum is still there. There is a real possibility that the stock will keep going higher at this stage, and if that tendency can be maintained, the short sellers would have no other choice but to recover their positions. Now, keep in mind that a lot of this is built on the trust of each other, and there is no actual contract binding them. This is why going forward, even if I'm very optimistic about Progenity, I feel like the risk profile of Progenity is actually quite high. My recommendation is to have a position in PROG and don't mind too much the entry point, because the bottom line is, if the short squeeze succeeds, the current price points will not be that relevant. I would recommend to keep your exposure to Progenity within 1% of your portfolio and to take profit once the uptrend starts to reverse. Looking at the current environment, I think that we gotta be careful with having exposures in the equity market. The market has been predicted to eventually go through major pullbacks or even recession for more than a decade since 2008. And that its future outcome depends on a number of elements. After the QE years and the drastic increase in asset price and the corresponding decrease in their yields, we gotta remember that the market doesn't mirror the economy, because otherwise we would have seen a market trading a lot more sideways than upward. And then 2020 saw another big push in asset prices. And this time, not just the blue chips, but also everybody else. There are quite a few explanations. The first one is that more money is been printed across the world. And because the real economy has been stagnating on the outside, the capital then entered the huge melting pot of globalized finance and has been chasing returns, quite simply. That was the case for quite a while, but now that QE has been touching its end in North America and in Europe, they're closing down the process as well. I don't think that newly printed money will keep playing a key role in maintaining the asset prices up or even higher. But this decrease of new money is compensated with the increase of geopolitical tensions across the world. And the more tensions there are, the more money tends to flow to the US and North America because it is perceived as a safe haven for capital from different countries, especially the ones that are currently seeing turmoils or social unrest. One last phenomenon is the attempt of market participants to protect their capital by creating artificial little bubbles of speculation so that their money not only can be protected, but can also get a gain, potentially. So an example of this would be the EV sector back in 2020. What all these mean for the market is that the degree of uncertainty will increase over the next couple of months, especially as the expectation for a recession has been building up since then. The recent announcements from US Fed, the accumulation of economic difficulties coming from all over the world, all contribute to this increase of volatility. Basically, I think that it's very important to keep the speculative plays at a reasonable level. A healthy portfolio normally contains a healthy percentage of its positions in sectors that are different and of classes of assets that are mostly stable with predictable cash flows, like REITs, fixed income assets, and preferred shares. The rest should then be invested in growth stocks or to stay cash heavy in the case there's an opportunity to scoop the bottom. Overall, I think that the current environment does make me believe that there will be opportunities to average down the cost basis, and this is why the initial position should remain small so that we can afford to average down further down the road. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.